Hi, I'm Chris Wright, president of Wright Wealth Management Group. Over the past, I've received a lot of questions from investors who have owned real estate that has highly appreciated over the years, and they have a desire not to pay a lot of money in capital gains taxes. So they've often looked at exploring other alternatives than cashing out their property or selling a business and having this large amount of capital gains triggered upon that transaction or sell. When we have a large piece of property, or maybe a commercial building or a ranch or other types of real estate holdings that have appreciated significantly over time, we have a couple options that we can implement with those sales to help reduce or even eliminate taxes, or really what we're talking about is spreading that tax hit over a certain period of time instead of receiving all of those proceeds or taxes in 1 year. One of the ways that we can accomplish this is by doing what's referred to as a 1031 exchange. If we have a real estate property that's appreciated significantly in value, we can hire an intermediary, a company that will hold the money while we recognize or identify other properties that we would like to use the proceeds of the sale from, and roll those proceeds of that sale, of that existing property, into new properties. This is done quite often, but a lot of investors really don't know if they want to continue owning individual properties and having the hassle of being a property manager or taking those phone calls every month from tenants when something goes wrong. So instead of doing a typical or an individual 1031 exchange where an investor would find their own property, let's say somebody owned let's say an IHOP restaurant, and that individual that owns that IHOP restaurant, or their tenant is an IHOP restaurant. The investor wants to sell that building that is leased by IHOP. That investor could sell off that building to a new buyer, take the proceeds, and then take that money and roll it over into maybe another commercial real estate building in another state or another area. Well, a lot of investors are finding that they do not want to manage individual properties or commercial properties or even residential properties, but would like to have an option where they could still take advantage of the 1031 tax-free exchange benefits, but have somebody else manage those properties. So what that moves us into is, for those who do not want to manage their own properties through the 1031 exchange, they have the opportunity to join into 1031 portfolios that are managed through big real estate companies that may offer 2 or 3 or 4 different properties within the portfolio that your money can be exchanged into, and then you can receive a rate of return on your investment dollars paid to you over time that would be distributed as principal and interest over 10, 15, or 20 years, thus reducing the total capital gains tax hit that you otherwise would have had imposed upon you if you would have sold out the building and taken the cash. An additional item in regards to 1031 portfolios, where a seller would take the proceeds of their, let's say, a commercial building, and then that seller wants to roll those proceeds into a pooled portfolio of several properties that is registered with the SEC, that is put together by a large real estate investment company. Those types of programs do have suitability requirements, and those programs that are set up for investors that no longer want to manage individual properties but be a part of several portfolios that have many properties within the portfolio, there are suitability requirements that have to be met for investors to participate in those types of portfolios. The main requirement is that the investor is an accredited investor, meaning that investor has at least $1 million or more of investable assets, excluding, not including their primary residence. That is what the definition of an accredited investor is. However, many investors that have highly appreciated real estate are in actuality accredited investors. Therefore, they do qualify to the suitability standards of being able to participate in these 1031 portfolios. So this is an additional type of 1031 that a lot of investors look at to help reduce that total tax hit over a certain amount of years, but also to reduce the amount of time that an investor had been maybe spending managing or being a landlord of a commercial building or a residential property, and they really aren't at that point in their life where they want to take those phone calls, handle the plumbing, handle the maintenance, the landscaping, or even make phone calls for other companies to come in and take care of that. They would like to be in a portfolio that owns many qualified commercial real estate holdings, and they're simply collecting a rate of return and a portion of their principal each and every year and spreading that out over a certain amount of years set forth in the future. The question that's often asked, what do I do with highly appreciated real estate, or what do I do with a highly appreciated business that I've owned in the past but want to reduce the amount of tax I pay over many years in the future? As an independent financial advisor, we have many of the solutions that investors need in regards to 1031 exchanges. These types of programs help to spread the amount of capital gains tax that an investor will be paying over several years in the future instead of having that big hit from capital gains all in one year. I'm Chris Wright, president of Wright Wealth Management. Thanks for joining our podcast today, and we look forward to you attending some of our other podcasts in the future.